Let's get over to Cleveland, Ohio. David Kelly is there. He helps to oversee $445 billion as chief market strategist for JPMorgan Funds. David, thank you very much indeed for joining us. So the Fed meets this week, of course. No way there's going to be a change in rates. But what about the language? People are saying there's not going to be any change in the language and the rhetoric either.
No, I think there's going to be very little change in the language. The last time they met was on April 28th. Since then, we saw the European debt crisis worsen, and now we've seen it improve. And conversely, we've seen the U.S. economy slow down somewhat. So I don't think the Fed can be any more optimistic than it was on April 28th, but I don't think it'll be, I think it'll still want to say it believes that the economy is expanding. But again, pushing off any Fed tightening for a long time here. I think they really want to make sure this expansion is well on its way before they start tightening.
We can talk about expansion, but not expansion in the level of employment. That's the key issue, isn't it?
Well, yeah, but the economy will produce jobs. It'll produce them slowly. I think people are a bit impatient when it comes to job creation. You always need about 2 quarters of good economic growth before you begin to create jobs. We got that in the second half of last year, and the economy has begun to create jobs in the first half of this year. And we've got a lot of different numbers on employment, but they're all basically saying the same thing. Over the summer, the economy should be able to produce a decent number of jobs. 250,000 jobs per month, I think, is quite possible over the summer. It's not as fast as people would like a job recovery to be, but it's fairly secure here. So I think I don't think there's much doubt about the fact that that unemployment will gradually come down if the economy keeps going here. I just think there's a lot of fragility in financial markets. A lot of people are very negative. We do have the worries about the European debt crisis still affecting how investors are behaving. And I think because of that, the Fed just wants to be sure that people feel good about the economy or better about the economy before they start tightening.
Astonishingly high yields of late on 10-year treasuries. That tells us one thing, but also on the other hand, we have equity markets which are showing signs of skittishness. What do you take from that? Well,
I think that investors, long-term investors, just aren't participating in the equity market at all. And I think that's one of the reasons the market is having such a difficult time gaining momentum here. If you look quarter after quarter, the earnings are going up. The expansion seems to be more or less on track here. But investors got burnt throughout the decade of the 2000s, particularly at the end of the decade of the 2000s. So if you look at the last 30 months, in every single one of the last 30 months, we've seen more money flow into bond funds than stock funds. That's a pretty nervous investor.
David, let's move to China and the China story here as well, with the Chinese authorities moving on the yuan and announcing that it will make itself more flexible here. That was received positively by equity markets, and then we saw them actually sell off at the end of it. Why was that the case?
Well, I think the sell-off is partly because there's just no long-term investor money going to the stock market. I think that's what's hurting. I think it is a positive story. It doesn't really, to me, it doesn't really matter how much they move the currency. What I think is really important here is that they are receptive to the idea of a more flexible currency. They were clearly trying to do this ahead of the G20 summit. I think they want to be a cooperative player in the global economy, part of the solution, not part of the problem. And I think that's a very positive signal of realism from the Chinese. So, I think markets ought to react more positively to it. But as I say, people just aren't in the mood to buy stocks these days.
Yeah, exactly. But the fact that they're not tells us another thing, doesn't it, to some extent? Because, as you say, nobody's really in the mood to be in these equity markets. But overall, how are you balancing your funds right now? What's the asset allocation looking like here?
Well, overall, when we talk to investors, obviously we believe that each investor needs to have an appropriate portfolio for where they are in life. But we do think that in general, investors are a little too pessimistic here. Over time, the gradual drip of rising employment, rising corporate profits, positive economic growth will gradually deal with a lot of the worries that built up over the last decade. That should push stock prices and interest rates higher. So we would be a little bit more tilted towards equities and away from fixed income.
David, thanks a lot for that. David Kelly there joining us from Cleveland, Ohio.